Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we've got a brand new video for you explaining the correlation between the currency market and the equities market. I want to try and explain to you today what happens when the pound falls, what happens when the dollar falls, and how that affects you as an investor, how that affects your investments, and how that affects the stock market in general. So if you like that, I want to know why. Please like, please comment, please subscribe, please share. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple and transparent manner. But first, today, let's tackle the issue. Let's tackle why stock markets rise when currencies fall and try and explain it in a really clear way. So the reason why I'm creating this video is that, as you guys know, last week I think it was announced that the pound had dropped to an all-time low for the past couple of years, and the pound in relation to the dollar rather, was $1.21 to the pound. Now, the question then came up: what does this mean for my investments? And so I wanted to try and put a quick, really simple video together just to try and explain. And so I sort of scoured the internet to try and find the best explanation, just to make it as crystal clear and as crystallized as possible. And I think this article is the best at explaining that. So if you just want to read the article and get your answer, feel free to click on the link in the description, go read the article, and you're more than welcome to leave or exit the video. It will hurt. It will definitely hurt. However, I've been hurt before, and as Gloria Gaynor said, I will survive. But if you want me to read the article to you and explain little bits as I go along, then obviously stick with the video as I currently do that now. So this video is from Schroders, and it says the FTSE's 100 strong recovery after Brexit verdict in last June's referendum caught some investors off guard. So just to let you guys know, this was made back in 2017. After an initial wobble, the index surged. 3 months later, it was 10.4% higher. But why? Other factors may have been at play in those months, but one of the strongest drivers in the fortunes of the FTSE 100, or the FTSE, was the performance of the pound. This is because such a large proportion of profits for FTSE 100 companies are made in dollars. If sterling weakens, then dollar revenues, once converted back into sterling, are worth more. So if sterling drops, then once dollars are converted back to sterling, you are getting more sterling for your money. So effectively, they become worth more. In 3 months, when the FTSE 100 rose 10.4%, the pound fell 12.8% against the dollar. And this graph is kind of showing that there is an absolute kind of direct correlation and convergence. The pattern of the way the sterling falls is kind of a mirrored pattern in the way the FTSE 100 rise. If you can kind of see that, it's like a mirror. So it kind of works in completely the opposite direction. This effect has become more pronounced given the sheer volume of profits earned overseas. As the chart below shows, 71% of revenues generated by FTSE 100 companies come from outside the UK. So just to be clear, only 29% of FTSE 100 revenue, or FTSE 100 revenue comes from inside the UK, inside Britain, Wales, Northern Ireland, etc., Scotland. It doesn't come from the majority. The lion's share comes from outside of the UK, and this graph is going to explain that for you. The strength of sterling against the euro is also important given the large chunks of revenue accounted for by France, Germany, Italy and other eurozone countries. The inner ring illustrates that 97% of the companies of the FTSE 100 have registered head offices, i.e. they are domiciled in the UK. The outer ring is the most important part. It shows the regions from which FTSE 100 companies generate their revenues. All but 28.9% are generated outside the UK. So 28.9% are generated inside the UK. Everything else is generated outside the UK. And you can kind of see that in this chart basically outlined here. Now, consider a simplified scenario of currency movement. If the exchange rate was $2 to the pound, then every $1,000 of revenue would be worth £500. So that's pretty simple, just basically double, right? However, if sterling weakened and the exchange rate moved to $1.5 to the pound, then every $1,000 of revenue would be worth £667. So effectively, for people outside of the UK, they're getting more for their money in terms of more pounds when sterling weakens. The outcome is that revenues increased 33% as a result of the fall in sterling. Advertising firm WPP is among a number of UK listed companies which have recently announced that their earnings have been benefited from sterling weakness. It can have the opposite effect too. Engine maker Rolls-Royce recently announced that its profits were being impacted by weak sterling. The notion that a falling currency boosts local stock market applies to most markets, but the extent depends on the market's reliance on foreign revenues. The FTSE 100 is a particularly strong example of this, with the dramatic effects of Brexit underlining the point in 2016. So, to sum up, and it's a very, very short and easy to read article, to sum up, if the market gets the majority of their revenues from other nations, then when the pound drops, or the dollar drops, if the United States gets most of their revenue from other nations, wherever they get their revenues from, that kind of dictates what might happen. And so if the pound drops in that instance, then you might actually see a better performance because they're getting more of their money from abroad anyway, and so you will see a correlated better performance in the FTSE 100 and potentially in revenue. And what that can also mean is that companies will report a higher revenue because effectively they are getting more money because, you know, the pound is cheap, so to speak. So, you know, foreign companies that are, you know, buying whatever goods and services that are relevant to the FTSE 100 companies are effectively getting more for their money, and more when it's converted back to pounds, it's more pounds effectively. So that is a slight example of the correlation. Now, if I go to, you know, Simply Wall Street, one of the things you see here is this currency gain, and that's another way that this is kind of explained. So if I, as a UK investor, invest in US stocks and the pound weakens, then effectively the dollar has risen. If you understand that correlation, if the pound weakens, then by virtue the dollar has risen, if that makes any sense. And because the dollar has risen, what that then means is that when I convert that back to pounds, I actually get more pounds for my money. So this currency gain, a few videos, if you go and check back a few videos, you will see it's around £20, £12. It's around that mark. Very recently, because the pound has dropped so much, it's gone up to £64. So all that basically means is if I sell my US stocks, because when I convert it back to pounds, I'm going to get more pounds for my money because pound is cheap and it's weaker than the dollar, then effectively what that means is that I make a little bit more money from a weaker pound. So that's just another way to explain it in real time, and that's one of the reasons why I love having Simply Wall Street, because it just kind of clears that up for me in a very, very clear and simple way. So in short, a weaker domiciled currency can have a positive effect on your stocks, because if you buy in international stocks, then when you convert it back to pounds when you sell, you will actually be making more money. But also the companies that you're invested in the UK could potentially report higher revenues, because the pound is cheaper and they'll be getting effectively more investment for their money, or the foreign companies will be getting more investment for their money, because the pound is weaker. So that just shows the correlation. So when you see a weak pound, I wouldn't panic. That can actually be quite a positive thing. It can also be a bad thing, broadly speaking, that, you know, the UK as a whole is, you know, a less attractive place, and, you know, the whole UK economy is becoming weaker. But that's from an economic standpoint, and not necessarily always correlates to from an investment standpoint. Sometimes these rules are slightly different depending on which perspective you are looking at. If you're looking at the perspective from, say, a UK consumer that's looking to fly abroad, then a weak pound is a horrible thing, absolutely horrible thing, because what a weak pound will mean is that now you can buy less dollars for your money. So when you want to travel to America, you get, you know, much less for your money than you would if the pound was stronger. So from a consumer standpoint that's traveling abroad, going in that direction, it's not a great thing. But from an investor standpoint, particularly if you've got investments already purchased and then the pound drops, it can actually be quite a good thing for you. So I wanted to clear up what the correlation is between currencies and between the stock market. Hopefully this was clear for you. It's clear for me, but it might not be clear for all of you guys out there. So if it's not, please get in the comments and I will do my best to try and, you know, tighten up and make it as clear as possible. But I thought, let me make this video. I'll leave the link in the description if you guys want to see, and hopefully you guys found this useful. If you did, please like, please comment, please subscribe, and I will catch you next time with another investment video. Happy investing. Take care.